questions at the end of it. So we hope to wrap up in about an hour. My name's Stuart Carter. Let me introduce myself. I'm a partner of Phil Fisher's Energy team. I'll be chairing this session this morning. I specialise personally in commercial oil and gas with transactional project experience as well, both in the UK and the MEA region. I will today be joined by colleagues Ollie Abel-Smith and Dougal Mulson, and I'm very pleased to welcome to this session Deo Ukasami from Templars, whom many of you may already know from previous experience. A little bit about the marginal fields regime. After a number of false starts, the Nigerian government finally commenced in June 2020 the long-expected bid round for the current marginal fields. Back in 2003, people may remember the original bid round. It's only met with patchy success, and I think only 9 fields are currently producing. And clearly, the Nigerian government is going to build upon more success than this going forward. Okay. Let's return to our speakers, say a little bit more about them. We are joined by Deo Ukasami, as I mentioned. He's a partner at Templars. For those who don't know, one of Nigeria's leading and largest law firms. Deo himself has over 20 years legal and commercial experience, gained both in private practice and working in-house, much like myself, my own background. He's a recognised and respected lawyer in the energy and project space in Nigeria, and clearly has built a very strong reputation within Nigeria for his work, and he's written up in many of the directories. Following Deo, we'll have Ollie Abel-Smith. He'll be our second speaker. Ollie's a colleague of mine at Phil Fisher. He's in the London and Banking Finance Department, and he himself specialises in debt financing, and he comes to this discussion with some extensive Africa experience as well. And finally, we'll be joined by Dougal Mulson. He's also a colleague of mine at Phil Fisher. He's also a partner in the London Banking and Finance Department, but his expertise lies more with derivatives and structured finance, but equally he comes with extensive Africa experience in the background. More about our speakers can be clearly found on each firm's website, or you can go to their LinkedIn profile. Before I actually go into the main body of the discussion, to take you through the Blue Jeans, what we're offering, there are opportunities to ask questions through the chat line onto the right-hand side of your screen. We'll pick these up as the presentations are given at the end. We shall select from these questions for the particular speakers, and they can talk. Given that it is Blue Jeans, you do have facility to chat directly. I would suggest probably better not, in case we have too many people trying to speak at one time. So the ideal way of getting your questions asked is actually to use the chat line. So I'd be very grateful if you would do that. As I said, we're set to last about an hour. Let's crack on. It's 3 or 4 minutes past 11 already. So let me introduce you to Deo Ukasami. He's on screen now. Deo, if I could pass across to you, and you can kick us off about the marginal fields regime.
Thank you. Next slide, please, Chloe. Good morning, ladies and gentlemen. Next slide. So to give you a bit of history regarding what we're going to be going through, I'm going to give you a definition and the history of marginal fields. We're going to run through the regulatory and contractual framework. I will touch upon financing, but it would be delved into a little more detail by my friends over at Phil Fisher. We will touch briefly upon dispute resolution and then an overview of the 2020 rounds. Next slide. So for those of you who might not be aware, a marginal field is a field that has been designated as such by the President of Nigeria. 2 other characteristics of it: they are usually discovered fields that have not been developed, and they've been left dormant for over 10 years. So they've been discovered, they've been left dormant, and then the president designates them as a marginal field. The marginal field originally, the regime started out by virtue of an act in 1996, but kicked off by a bid round in 2001. And the idea was to increase Nigerian participation in these oil and gas assets. So they were usually given to Nigerian assets holders, Nigerian-run companies, albeit some of them entered into joint ventures with other companies. As I mentioned, the first bid round had in 2003. Development has been quite slow, though. About 30 marginal fields have been awarded to date. There are only 9 currently producing. You will see that I've mentioned that 11 of them were revoked just before these bid rounds were announced. But it's important to point out that these were assets that have been held by these awardees, some of them actually since 2003, and they've not been able to get them to production. The major constraint for the marginal field holders were limited financial capacity and technical expertise, hence them partnering up with people with more technical expertise and money. And what I would call, based on my experience, and overly optimistic business expectations from the local partners. An example being you pay $150,000 sign-on bonus for the first marginal field rounds. When you want to bring in a foreign partner, you ask them to pay $5 million. However, despite the slow start, there have been some success stories. You'll see I've mentioned a couple of the successful marginal fields. The Okwok marginal field is doing about 17,000. The Umasege is doing about 16,000, and Otakiko is doing just north of 5,000 barrels per day. Next slide, please. So we now go into the regulatory framework of it. Marginal field operations are governed primarily by the Petroleum Act, which is the basic and the roots of all oil and gas legislation in Nigeria. Beneath that, you have a section in the Petroleum Act which gives that definition and allows the president to do that. There have been various marginal field fiscal and operational regimes and guidelines that have been issued over the course of 2001 up until 2005, and even recently as far as 2013. When you leave the Petroleum Act, you have the Petroleum Profits Tax Act, which is the fiscal act that delineates the applicable tax and fiscal regimes, and in some cases, fiscal incentives. The Nigerian Oil and Gas Industry Content Development Act, also known as the Local Contents Act, as well as the Associated Gas Reinjection Act, which would apply to those marginal fields that have natural gas in them. The key regulators are the Ministry of Petroleum, operationally headed by the Minister of State, while the substantive Minister of Petroleum is the President of Nigeria. Beneath the Ministry of Petroleum Resources, you have the DPR, the Department of Petroleum Resources, which is headed by a director/CEO, and they supervise oil and gas operations carried out by various licenses and leases. And tied to the PPT, the Petroleum Profits Tax Act, is the Federal Inland Revenue Service, which, as we all know, the only certain things in life are death and taxes. Next slide, please. So moving on, we have the contractual framework. The marginal field itself exists in an OML, that's an oil mining lease, and it's excised from that oil mining lease by way of a farm-out agreement. So what you would have is the awardee of using the current bid process that is going to happen now. They will sign a farm-out agreement with the holder of the OML. Upon the assignment of that marginal field, that farm-out agreement becomes your title. So the marginal field, even though it exists within the OML, has separate title during the duration of that, and the marginal field holder actually reports directly to the DPR as its regulator. There's still a couple of overlaps with the OML, being that while there's a ring fencing of the OML, the marginal field holder will still pay an overriding royalty to the OML holder. They will still have to indemnify the OML holder from environmental costs, abandonment costs, and general environmental and detrimental liability. The farm-out agreement, apart from this, also applies for, provides for the fact that the government can participate in the marginal field by way of a back-end. And a back-end is something that is provided under Nigerian law. It's a regime where the government, after production, can decide to participate in your upstream assets. And you can see my last point there being abandonment, and abandonment security needs to be provided for. One question I usually get is, if it's distinct, how do you work with your operational parameters within the OML? Your farm out agreement requires the farmer to provide support on the evacuation of hydrocarbons, because some of these marginal fields are close to clusters and they don't want you going to build new infrastructure. So all things being equal, you should be able to tack on to existing infrastructure to evacuate your crude oil or natural gas. Next slide, please.
Deo, before you go on,
yes.
As a lawyer, quite interested, just to be clear, a sub-license is not created or carved out of the OML.
Well, technically it is. It's actually a sublease. So what happens is that the farm out agreement creates a sublease. So you're a sublessor of the OML holder, but you are still directly regulated by the DPR, and your license is separate from the OML holder. So you're not reporting to them. You're a sublessor. You pay your overriding royalty. You also have to ring fence any kind of abandonment and environmental liability. But apart from those two, you're, for all intents and purposes, a standalone asset holder.
Okay, that's clear. Thank you.
Okay. Now, like I said, Oliver and Dougal are going to go into financing, so I won't spend a lot of time here. But the issues that we're already currently seeing now, and I'll talk towards in a little bit, because the bid rounds is going and submissions are due in over this weekend, is at this stage, at the acquisition stage, there is the equity that is usually the case. And then post-acquisition phase, you've got the revenue and retained profit scenarios, working capital facilities, pre-export finance. You have secured and unsecured and hybrid financing, and very popular in Nigeria are carry arrangement. But after my presentation, Oliver and Dougal will be going into more detail with that, so we can move on to the next slide. Right. So now, as most of you are most likely aware, there's been a bid round that was announced on June 1st. They announced 57 marginal fields located in land, swamp, and shallow offshore. The number is down to about 46 now, because if you recall the previously mentioned 11 revoked marginal fields, those holders went to court and they got an injunction. So right now we're working with the number about 45, 46. The DPR issued guidelines for the awards, and there's a 10-step bidding process that commenced on June 1st. They also issued additional explanatory notes about a week after, and submissions for pre-qualification that was previously the 15th of June has now been extended to the 22nd. The entire process is expected to run in less than 6 months. However, from discussions I've had with the regulators and the accelerated timeline that we're seeing for the pre-qual and what we expect for the commercial bids, we expect this to actually be wrapped up in far less than 6 months. In my estimation, we're looking at late Q3 at the latest, because they're quite keen to get this completed for reasons that I will come into now. The awardees are expected to bring the marginal field to production within 60 months, which is 5 years, if my math is not too bad, which, if you can compare to the 2013 bid rounds, provided for 24 months. But you would also recall that this would show that the Nigerian government is perhaps having more realistic expectations, because the 24 months that were granted in 2003, 15 years later, you still had those owners who had not brought it up onto production. So the idea is that you bring it up to production within 5 years. If not, you lose that license. Some important points I thought to mention are the timing. People are asking, is this the time to hold the bid rounds? Considering shrinking global economy, the oil price, and of course, that virus that we're all tired of hearing about, and that word called pandemic that I'm personally tired as well. Or is this decision strategic and informed? After the bid rounds in 2003, the government said they would have it in 3 to 5 years. And I remember preparing then, thinking that there will be a bid round for Marginal Fields later on. Nothing happened until about the end of 2013, when the government actually announced another bid round, actually named certain assets. But what happened is that it got delayed and it could not go on. It could not go on further to that. So you had a situation that we are now at a place that the Nigerian government needs to raise capital because they have liquidity challenges. You add that with the fact that there's the expectation, we can decide if it's realistic or not, that they need to raise about $500 million from the bid rounds, which if you look at about 46 assets, they're looking at an average of $10 million an asset as a sign-on bonus. Now, this is a marked increase from what you had in the 2003 rounds, which was $150,000. In 2013, when they were going to start their bid round, they said it was going to be $300,000. And the expectation is that these prices will be dependent on the size of the asset, but it's still a large escalation in the signature bonus. There are no incentives mentioned as of now. There are issues that need to be clarified regarding financial incentives because the fiscal regime is constantly evolving. Nigeria this year passed an amendment to the Finance Act, which is being challenged by the courts, but it sought to repeal withholding tax exemption on dividends paid out on petroleum profits. And that in itself was quite an attractive fiscal incentive for international partners signing into these assets. Another thing that those who had reached production had an issue with is the baseline tax rate for Nigeria upstream productions for crude oil is 85%. The marginal field holders applied to the DPR and the Nigerian government for a fiscal incentive that reduced the tax rate, and there was a letter issued by the DPR which sought to reduce the PPT rate, the petroleum profits tax rate, from 85 to 55, and provided an investment tax allowance of 20%. Now, that in itself, being issued by the DPR as opposed to the FERS, has been somewhat of a challenging issue, but marginal field owners are applying that reduced tax rate as well as the investment tax allowance incentive. Next slide, please. And then on the next slide, we are now going into some of the details regarding the bid rounds. Apologies, we seem to have a delay. Next slide, please. Okay, while we are dealing with that until it comes on board. Here we go. Okay, so on my next slide, I am talking in detail regarding the costs that are associated with these bid rounds, and I will give that to you in a summary. You have a situation, and the major milestones are a registration fee of about $1,300 is payable to the Nigerian government, and those that are interested would have already done that because the idea is you should have done that before the 23rd. There's also an application fee, approximately $5,000, and that's when things start to ratchet up a bit. There is a pre-qualification fee payable by prospective bidders of about $7,000. You're going to pay a data prying and data leasing, which comes to about $15,000 and $25,000 each. You will be required to purchase a specific competent person's report for your asset, which is about $25,000 per asset. The competent person report is $50,000 an asset, and then you will also be able to buy specific field reports. All in all, the process whereby you will go for a bid would mean that you're spending roughly about $120,000 in official fees that will go to the Nigerian government. This is, of course, separate from everything else that you would pay your advisors on that. And then there's some key considerations that I thought to mention with this current bid round. The signature bonus is payable upon selection as a preferred bidder, but prior to the award. So the idea is after you've put in your technical and commercial, you will be designated a preferred bidder. Okay. Next slide, please. We're back up. So this is just where I ran through where we're talking through the technical and financial bid, the announcement of winners, and then the farm out agreement negotiation and signing. Could we go to the next slide, please, Chloe? Well, while we're waiting for that to pull up, the key considerations are the signature bonus is payable upon selection or prior to the award. They've not clarified what the signature bonus would be. I have put that it will be between 5 to 15 million. Now, nobody knows, and I know the 15 million would be quite high, and I've just used that by deducing the DPR's expectation that they'll get $500 million. Do I think that $50 million for a marginal field is viable or feasible, considering that some of these same assets you could have got it for a sign-on bonus of $300,000? That remains open to debate. And there has been considerable pushback by a number of bidders saying that by the mere placing of prices in the millions for a marginal field, you are impugning on the success of this process. It remains to be seen if the DPR are going to move back on that. Now, when they issued the guidelines, they issued a clarification. They issued a point that you had to be a wholly owned Nigerian or substantially Nigerian company to bid. However, the DPR issued a further clarification, explanatory notes that I mentioned earlier in my presentation, and now it is only 100% indigenously owned companies that can bid, either individually, jointly, or as a consortium. And they seem to favor the consortium because you had a situation where a number of individual parties without the financial or technical expertise to complete this bidded and won, and that's why you didn't have any assets get into production. Bidders must show proof of technical competence, so you must either be active in E&P operations, your key personnel or shareholders must have experience in that, under the assumption, like a lot of companies are doing, you're setting up a new co, SPV. You must have established relationship with a competent technical partner, foreign or local. Financial capacity is important because, again, maybe because the bid, the sign-on bonus was $150,000, a number of people could pay that, but they didn't have the development costs. And that was a big issue and a disappointment from the Nigerian government. So you're going to have to show evidence of your financial capability. Post-award now, and that's where it might be of interest to a number of the international people here. In the explanatory notes, the DPR has said that the awardee may assign up to 49% of the interest in the marginal field to another party. So at this point, you could have a situation where a foreign financier or technical partner or even an upstream partner can partner up with the Nigerian company. If you're going by way of a joint bidding agreement now, there could be a situation where you are supporting their bid as of now with a later on assignment of the interest to the international party. At this point, I'll conclude that before I hand over to Oliver and Dougal, that given the current political will and, importantly, the liquidity challenges of the Nigerian government, the bid round is going to close, I'd say, in the next 3 to 4 months. One other thing that is relevant and has been long ongoing as well is the Nigerian government has committed to passing the Petroleum Industry Bill, which has been in a state of flux for almost 12 years now and has caused a lot of uncertainty. It's my expectation that over the summer, this bill will be passed, however good or bad it is, but that would offer predictability to proposed investors. And although these are difficult times, I would say that this presents an opportunity with long-term benefits should parties choose to go ahead with this or invest in such. And at this point, I will I'll hand back to Stuart, who will then hand over to us, Oliver and Dougal. Thank you very much.
Deo, thank you very much for a very informative discussion now. presentation. We had a few technical problems. My apologies for that. The slides will be available to all these people who are registered, and we hope to have a transcript as well. So if you've missed some of the slides, don't worry, we can get those across to you. Questions have come in for you, Deo, but we will go through all three speakers first, and we'll come back to the questions at the end, just to keep the flow of the webinar going. So if I could pass over to Oliver Abel-Smith as my colleague in the banking team. And Oliver, over to you.
Thank you, Stuart. Dougal and I are going to go into a little bit more detail, as Deo mentioned, on some of the types of financing that Deo touched upon. I'm going to cover project finance, reserve-based lending, and pre-export finance facilities. Turning first to project finance, compared to other infrastructure-intensive sectors such as power and utilities, I think project finance, in the sense of non-recourse or limited recourse structures, has been less widely used by the oil and gas industry. That's not to say upstream facilities can't be project finance, and they haven't been lent themselves so much to that. Why is this? Project finance models look for stability. Future revenue streams are typically less stable and predictable in oil and gas projects than for large-scale infrastructure projects, which may have regulated or inflation-linked returns. Oil and gas projects can bring substantial logistical, infrastructure, and also social issues. And the track record across the industry, I think it's fair to say, for completing projects on time and on budget, is not necessarily wholly favourable. Touching upon some of the commercial and other risk factors, the strength of the security package over the project company and the project assets is obviously a key concern for lenders driven by local requirements. Lenders are also concerned by what protection in practical terms that security provides. Stepping into a part-developed project is an unattractive proposition. Other factors look to the stability of the project, in particular factors such as the quality of the resources and reserves, the technical challenges of the project, the track record of the management team or the consortium, and the likelihood of cost overruns and delays in reaching commercial production, and the political and fiscal stability of the country concerned. Next slide, please. Banks provide the majority of the capital. However, geographical sensitivities and capital requirements puts increasing pressure to limit commercial banks providing long-term finance for projects in emerging and developing markets. So both export credit agencies and development finance institutions do have a role in providing support for transactions. ECAs and DFIs are becoming more flexible and prepared to work alongside commercial banks. ECAs use loans, guarantees or insurance to promote the export of a particular country's national goods. They don't support a particular importer or exporter, rather they deploy capital to promote the country's trade policy. On the slide is a quote from the UK Parliament Environmental Audit Committee's report in June last year, investigating the scale and impact of UKAF's financing of fossil fuels. I think this quote highlights how ECA's participation gives comfort and facilitates the involvement of other providers of finance, especially in emerging and developing markets. However, this ability to attract other capital also brings pressure to align the impact of ECAs with national and international climate objectives and obligations. The UK Parliament's Committee's report recommended that UKAF should end support to new fossil fuels projects by 2021 and should align its work with achieving net zero emissions by 2050. Turning to DFIs, examples of DFIs active in projects in Nigeria include the Africa Finance Corporation, the International Finance Corporation, and the African Development Bank. The involvement of DFIs reduces associated political risks given their standing and relationship with host country governments. Their involvement, however, also comes with requirements for strict compliance with environmental and social standards. Next slide, please.
Ollie, having the privilege of the chair here, there is a question about I'd like to ask about DFIs. Is there a kind of common framework for the environmental and social governance issues?
Stuart, thank you. I think the short answer is no across DFIs in the sense that there are different institutions adopt different approaches. The IFC, I think, has its own World Bank framework. More broadly for project finance, the Equator Principles are the commonly referenced framework, which are similarly as a risk management framework, which are voluntarily adopted by financial institutions for a number of different products, including project finance, subject to certain value thresholds.
Okay, Ollie, I'll promise not to doorstep you again on that one.
No worries. So moving on to reserve-based lending. Mid to large cap independents are perhaps the largest users of RBL facilities. These players typically use RBL structures for development financing and general corporate purposes. RBLs enable the raising of debt across a number of assets at various development stages and allow for the retention of a degree of operational flexibility. Structures have developed differently between the longer-standing North American markets and those financed internationally. I think trying to summarize the key features of an RBL in an international project in an international project context. First, commercial banks make funds available to cover CapEx, OpEx, and development costs for a number of specified assets. In doing so, they spread the risk across those assets, and for general corporate or working capital purposes. Facilities may also cover refinancing of existing equity debt or sort of hybrid financing, or the financing of an acquisition. The available loan under RBL fluctuates on a 6-monthly basis by reference to the borrowing base amount. This is calculated using the most recently delivered banking case that covers each of the included oil and gas fields. This would typically identify the NPV, net present value, of future cash flows from each field, taking into account their current status, being producing, non-producing, or undeveloped. As commodity prices fluctuate, so too does the available loan commitment, as this will feed into the determination of projected future revenue. For the purposes of determining the borrowing base amount, RBL lenders consider only proven and probable reserves, not possible and contingent reserves, and the extent to which projected production figures enable debt service. Banks typically require loan tenors to match production profiles, as lenders seek full repayment by the early of the reserve's tail date and a short to medium-term maturity of 5 to 7 years. I think the expected life of most marginal fields is out between 8 and 15, as I understand it. Next slide, please. So continuing on this, the typical financial coverage ratios are the loan life cover, which is the ratio of the NPV of projected cash flows for the period to the maturity date of the loan to the outstanding amount of the loan. The project life cover, which is the ratio of the NPV of the projected net cash flows for the period, and this varies to the date on which the field costs are greater than revenues, again to the outstanding amount of the loan. And the debt service coverage ratio, which is CFADs, the cash flow available for debt service, to debt service requirements in the relevant calculation period. A robust security package will typically be required, covering secured project accounts through which revenues are to pass in accordance with the payment waterfall, security over borrower shares, and borrower assets which can be subject to security in Nigeria. There will be a fixed amortization schedule and prepayment of cash, i.e. a cash sweep, to the extent that the outstandings of a loan facility exceed the borrowing base amount. And there are often detailed provisions on the ability to add or dispose of the field assets on which the borrowing base is founded, subject to various conditions being met. Next slide, please. So, turning to types of production financing, the main categories are PXF, prepayment financing, streaming, and royalty arrangements. Typically, in each case, the off-taker's payments or notional payments discharge the loan amount or prepayment or upfront capital amount. Pre-export finance, at its simplest, is a loan secured against receivables. Next slide, please. I've got here a diagram of a typical PXF structure, and just stepping through the elements. The producer enters into the financing directly with the lender and is the borrower for accounting purposes, producer down in the bottom right of the slide. They also enter into the offtake contract the third-party off-taker or any number of a panel of off-takers. The off-takers pay for the oil directly into a collection account, which the proceeds or a portion of them are then automatically applied to repay the lenders. And the lenders take a security package comprising typically an assignment of the benefit of the off-take agreement, a charge over the proceeds of the collection account, and quasi-security in the form of guarantees to mitigate against production risk. Next slide, please. Here's some of the advantages of PXF. Strong off-takers have better credit ratings than producers. They're often in a more favorable jurisdiction than the producers, and this mitigates the lender's commercial and country risk. PXF is considered by banks to be a form of secured financing, although no physical security over the producer's tangible assets is being taken. And PXF provides cash which could otherwise be unavailable through opening up a wider group of lenders and keeping lenders on board who might have otherwise exhausted unsecured borrowing lines. And the fact that cash was provided offshore and through the collection account structure is generally very attractive to lenders, mitigating again country risk, and in many cases associated currency control or repatriation issues. Next slide, please. Turning to some of the issues in relation to PXF facilities to be taken into account. Having a bankable offtake contract is obviously core to the PXF structure. Lenders are looking for greater risk sharing, which can be achieved through long-term offtake contracts. So typically, to be bankable, the offtake contract would be expected to be in excess of the duration of the financing and not terminable or capable of suspension, and to mitigate payment risk by ensuring the quality of the off-taker and the terms of the offtake. Commodity price and currency risk is obviously a factor, although hedging can go some way to mitigating this risk. PXF only really works if there's a reasonable certainty as to production and delivery of the product, otherwise there are no cash flows. So examples that are going to feed into that concern are going to be similar examples for the project finance concerns, such as the technical capability, the production facilities, and the reliability of the expected production, and potentially competing demands on production as to other routes for the product, the oil. So for this reason, sometimes you might see a performance guarantee from a suitably strong sort of sponsor or consortium member to mitigate some of these risks. Finally, legal structuring risks are going to include jurisdictional issues, which maybe requires contemplating sort of central bank approvals and how security is taken locally, and any local sort of currency control. Sanctions are often increasingly a concern and factor. And lastly, change of law risk and obviously environmental liabilities. So with that, thank you. I'll pass across.
Ollie, thank you very much for that. Again, a lot of detail, some detailed slides, which people will have access to at the end. I would encourage people to send in through the chat lines any questions they will have for Ollie at the end. And we'll now have our final speaker, and that's Dougal, a colleague at Field Fisher, also in the banking and finance team. He's going to look more at the production-based financing, which is potentially available to developers. So if Dougal is available, I'd like him to come online.
Yeah, thanks, Stuart. I'm going to stay off camera at the moment, just to go through the slides, and then we can come back. I'll come back on camera if we have some questions after.
That's great. Okay, we look forward to hearing what you have to say.
Great, thanks. So Ollie's already touched on PXF. I'm going to talk first about something that's pretty similar, which is a prepayment facility. A lot of people on the call will probably be familiar with these and will have done both. And a lot of people think they're kind of interchangeable in terms of structure. But the key distinguishing feature of the prepay as compared to PXF is the PXF is essentially, you could say, bank funding provided by a funder secured on future receivables off the strength of an off-taker, as Ollie's mentioned. Whereas a prepay is really embedded, it's financing embedded in a sale and purchase arrangement under which a producer receives an advance payment, effectively the loan, against a commitment to deliver a fixed amount of product in the future, usually at a fixed discount or premium to the relevant benchmark. So if we can just move to the next slide, Chloe, we'll look at a diagram that I think is atypical, but I've kind of plugged it in because a colleague used this structure in the past somewhere, but it's a funny one. So the first prize goes to someone who can see a typo over one of the arrows on the right-hand side, which I'll mention when I get to the end. Anyway, in the center, you'll see a buyer entity. So as I said, contrary to PXF, the direct provider of the finance is not usually a bank or a financial institution, but it's more commonly a commodity trading company, or for example, the marketing division of an oil and gas major. It can also be a special purpose entity that's been established for the transaction. An SPV can be a convenient tool for syndicating the funding, and it can also be useful where there's more than one entity acting as an end off-taker. Now, in all of these structures, the buyer makes an advance payment to the producer, and this can be documented as simply as by inserting an advance payment clause in a typical contract of purchase and sale, but more frequently, it'll be documented in a prepayment supplement or full-on prepayment facility agreement, which will end up looking quite a bit like a loan agreement. There will often be extensive representations, warranties and covenants, events of default, cover ratios, and conditions precedent. Reimbursements of the advance payment are usually made direct by delivery of commodity to the buyer. Purchased commodities are priced at or around the time of delivery on the basis of a pre-agreed formula. Then the invoice value of the commodity delivered in a given period, typically 1 month, is deducted from the reimbursement installment that's due at the end of the month. And then where there's a shortfall in the value of the commodity that's been delivered, the relevant installment usually has to be repaid in cash. Now, there can be collection account structures like PXF, so it isn't always this direct delivery and set-off arrangement. It can depend on the local currency regulations in the country of the producer. But you can get situations where effectively the prepayor is paying for product in cash into a collection account, which is then being used to amortize the loan. Then again, although not illustrated in the diagram, the buyer can take security over assets or shares or rights under supply contracts to secure the reimbursement obligations. Then what would I say? I'll pass over the lending side of this structure, and just note that the structure may or may not involve hedging arrangements, often not, frankly, but it's used in the same way as any funding arrangement. And then
Dougal, if I could just jump in there.
Yeah.
Clearly, somebody's got their microphone open. I'll be very grateful for all listeners to go on mute until we get to the question times, and maybe they can ask their questions direct. But please do go on mute. Sorry for that, Dougal.
Okay. Yeah, thanks. So then I'll just get to this funny reference to bills of landing on the right-hand side of the picture, which I think is funny. So those are not new trade finance instruments or documents of title. So that was intended to be a reference to bills of lading. A prepay wouldn't usually involve security over bills of lading, but it can depend on the overall funding arrangement. But more usually in a transaction where, for example, the oil is being purchased on an FOB basis, then the issuance of the bill of lading would be the delivery date. And then the next installment of the outstanding prepayment could be reduced as of that date effectively, or at the end of the month, by the invoice value determined on a provisional or a final basis. And then where the trader has back-to-back funding, it might have an obligation to repay its funders at or about each time the prepay amortizes through deliveries. Now, if we could just move to the next slide. So hopefully we'll get to the next slide soon. There's a bit of delay. That's okay. So the main distinguishing feature of a prepay, as I said, is the key role of the buyer. And the buyer can source its own finance, meaning that bank lenders do not need to face the producer as a direct borrower. The buyer typically, in this case, would be viewed anyway as a more creditworthy entity than the producer. Or if it is an SPV, it can be structured so that it is bankruptcy remote and be set up outside the producer jurisdiction, which can help to mitigate some aspects of country risk. A prepayment agreement can also sometimes be wrapped by credit insurance, which cover a failure of the producer to repay scheduled reimbursements when due. When the buyer is a large commodity trader, it may be able to propose a package that combines debt funding in the form of the prepay, a long-term offtake, marketing capabilities, and in some cases, equity. Then, just moving on, some people would ask the question, effectively, are they like banks? So I guess the main point here is that trading companies function somewhat like banks, but it's important to understand that they work in partnership with their banks and other sources of finance. So their involvement can also be critical to obtaining credit insurance. In reality, they're more like, I would say, specialized funding providers as opposed to banks. They could, for example, source their funding by borrowing from banks and other lenders on a full recourse basis. In that case, the trading company usually have more freedom to structure the prepayment financing with the producer largely as it sees fit. Or they can borrow on a limited recourse basis, in which case the ultimate lending banks or other funding providers will scrutinize the structure more closely. But even so, there'll be a dialogue between the lenders and the trader as to what kinds of structural protections are or are not appropriate or commercially feasible. And the funding will usually be structured so that there's an alignment of interest. And then if we could just move to the next slide, Chloe. Thank you. So very quickly, I'll go through a couple of the advantages and disadvantages further. I mean, one of the disadvantages, sometimes characterized as a disadvantage, is that the debt funding really is inextricably linked to the offtake. So that can be considered a disadvantage from the perspective of the producer, who might be locked into offtake terms, which could appear to be less favorable than what they could obtain over time with periodic competitive tenders. But on the other hand, by selling to a trader, the producer can avoid the need for a heavy internal marketing structure. And perhaps even more important, prepayment financing is rarely used as a primary or sole source of early stage funding because trading companies may have limited appetite for construction and development risk. So it's something to be used typically in connection with other funding techniques. We could just move to the next slide. Okay, I'm conscious that we're moving along in terms of time, and we want to leave some time for questions. So I won't go over the details of this grid, which again just sort of conveys advantages and disadvantages and perspectives from each party's view. I guess the main point that emerges from the slide is that, as I mentioned, I mean, the trader will view itself primarily as a commercial counterparty to a producer, as opposed to being purely a lender. So it can be likened in a way to a one-stop shop in comparison to a structure that involves bank financing on the one hand and one or more separate offtakes on the other. So with a bank-led structure, producers will end up having discussions about their business primarily with banks, whereas with a trader-led structure, the discussion is going to be with a trading company, which in the longer run will tend to be kind of a more commercial and market-focused conversation. Then if we can move to the next slide. In the next slide, I'll just be saying a word about streams and stream-like structures. So streams, royalties, forward purchases, whatever you want to call them, they're all effectively tailored financial contracts. They can involve purchases of fixed percentages of production for durations that can be fixed or variable, or they can involve a sort of purchase of shares of net revenues, or they can be effectively prepaid derivatives in the form of forward purchases of fixed or variable quantities, and they can be associated with caps, floors, or collars. Structures typically involve an upfront payment with, in return, an entitlement to cash payments determined by reference to a percentage of production from a specific field and by reference to prevailing prices at which the production is sold. Although in its simplest form, for example, a royalty is just a mineral license fee that does not involve the provision of funding. Whereas royalties usually start as part of the consideration that a buyer of a license pays to a seller, streams are bespoke bilateral financings designed to fill a funding need. Funding provider does not usually have operational involvement or an ownership interest in the underlying field. The rationale is really focused on upside of commodity prices, reserves, and production increases, but often with some downside protection as well. Streams are usually secured on a second ranking basis, for example, behind bank funders. And unlike prepays, which are reimbursed through physical delivery, stream payments are cash settled. Streamers would tend to say that they have a more competitive cost of capital and more access to liquidity by comparison to a producer on its own. They can be structured as well so that they're not considered financial liabilities for accounting purposes. They're an avenue toward diversification of funding sources, and a stream provider can be viewed as more closely aligned to a producer than a bank lender or a bondholder because of the production risk. Now, these instruments tend to be highly complex, so they need to be assessed carefully on a case-by-case basis from a financial, accounting, tax, and legal perspective. They're not one size fits all, and they tend to complement a funding package. They can readily sit alongside bank or bond debt and contractor financing with suitable intercreditor arrangements. And that concludes our summary of some of the techniques that could be imagined for financing in connection with the marginal field.
Okay, Dougal, thank you very much for that talk. If Ollie and Dougal could perhaps open up their cameras so all our guests can see us on the bottom. Hopefully that works properly. Hopefully that will work. Deo, before we actually get to the questions, and we do have quite a few to get through, any concluding remarks from your perspective, being in Nigeria, being in Lagos, to conclude the actual discussion?
Yes, thank you, Stuart. Well, I mean, in closing out, I'll say, while the current circumstances, there are challenging headwinds for any award process. There is the school of thought, which I subscribe to, that marginal fields may be less susceptible to the impact of low oil prices, as they tend to be smaller in scale, require less capital to develop, and are near-term development opportunities. Thereby, the exploration risk is slim, and in some cases, none. So there are advantages in going into this, and a number of the larger upstream producers in Nigeria now actually started out as marginal field holders. So this could be also a way to kind of get in and then lever up at a later date. Thank you.
Okay, very good. Right, we got a series of questions. I could take them just in the order we received them. So, but we may jump around because I think both Ollie and Dougal should have an opportunity to answer a couple of questions that come their way. But Dave, may I ask, I think this is a really interesting question actually, does the farmer have any revisionary rights in the assets, and does the license simply revoke back to the farmer if the field is given up?
No, because going back to my first slide, because the president designates it as a marginal field, it's actually in a basket of the Nigerian government. So it's with the DPR. So it's not been, it will not revoke to the farmer. That's the simple answer. But it's a little more nuanced. If it was revoked, like they tried to do with this bid round, they'll try and bid it out or give it to another party as well. And interestingly, one interesting point in the explanatory notes, they say that if you have a consortium of people working together and they cannot work with the asset and it's deemed to be one party's quote unquote fault, because there was a lot of infighting, they have a dispute resolution mechanism with the DPR, but they allow the DPR to, instead of revoking the asset, if it is deemed that this party is being, for lack of a better description, recalcitrant, that party could have its interests revoked and the other parties move on. So short answer is it will not go back to the farmer because it's deemed that they did not produce it for 10 years. So it's now, for lack of a better description, government's property.
Okay, that's good. One more question I'd like to ask you about the PIB, which is going through the legislature. Is that likely to have any impact on this process going forward?
Not on the process itself, but likely on the operating environment afterwards, right?
Right.
Because the PIB governs, they passed the governance bill. It'll change how the regulators are constituted. There are expected to be fiscal changes as well. The marginal field producers have a pretty strong lobby, and they have always pushed, and I would expect that, and it goes to another question that a gentleman asked, I think it was Raj from Cynthian Consulting, that we expect there would be benefits and incentives for marginal field holders that would separate it from the larger IOCs.
Okay, all right. We'll give other people an opportunity to speak. I've got a question now for Ollie. In your opinion, which sector or geographical location of the current financing market and existing oil and gas players are showing the most interest in marginal rounds? It may not be a question for you, maybe it's a question for Deo as well. If you want to express.
I think Oliver can go first if he has any thoughts, and I can chip in.
Yeah.
Yeah, no, well, I'd certainly welcome, Deo will have views, and perhaps even any other members of the audience will have views or experience from conversations that may be having. I know sort of some of the European banks obviously been involved in Nigeria before, the likes of SCB and BNP. My inclination, I suppose, or expectation, it may be for this marginal fields round from the bank perspective, it may be more likely to be African-based banks, be it DFIs or local commercial banks from the bank side. But perhaps also picking up on the comment that you made, Deo, in relation to sort of carry as a source of financing, which is not something we particularly touched upon. That's more likely to come from large oil services companies, perhaps the likes of Schlumberger. So that may also be something that where there's activity or interest in this particular marginal fields round. But yeah.
Yeah, I agree with you. To the question, we're not seeing, at least at this stage, a lot of bank interest, and it's understandable because at this stage, first of all, they want to ensure that you've obtained the assets. I don't see a lot of them coming in at signature bonus stage. It'll be production going forward, and then they're adopting a wait and see. The interest I'm seeing, because as you can imagine, these are busy times for upstream lawyers. It is more for the independent and what I'll call smaller IOCs. It's not regional. We have seen some bidders have interest from the Middle East, but not the national oil companies, some of the smaller ones based out there, as well as European-based E&P and, like Ollie said, service companies who are trying to adopt a kind of contractor financing scenario. So I don't know it's regional. I can't answer that for sure. But sector, I'm not seeing a lot of bank interest, at least traditional bank interest at this stage. It is mostly from those who have a service or the technical expertise to put into that, which is also, Jonathan, who asked the question, which is also reflective of what you saw in previous marginal field rounds as well. Some came in on the RBLs and some did come on some pre-export financing. But as of this stage now, it's more from service and E&P companies I'm seeing the interest to kind of partner up.
Okay, it's good to hear. There's another good legal question, actually, that if the OML expires, but the field can still continue to produce, what's the status with that field now? Does it get its own distinctive OML, or what legal regime?
No, it would still. It would. Yeah. So that's a very good question. So now, working backwards, right? As I mentioned, your title is the farm out agreement, and we describe it as a sublease. So it is actually a good legal question, because if your head lease does not exist, where will your title subsist from? My short answer is this: it would not expire. The government will, because what happens is that the OML devolves back. If it expires and it's not renewed, it will be assigned to another party, or it goes back into the government's pot, right? So if it's going to be assigned to another party, that party will become the head lessor. If it goes back into the government's pot, and remember, most of these OMLs actually have Nigerian government participation in these assets. So it would expire from the point of view of, in talking practically now, the IOCs, but the government still holds it. So these marginal fields would still run via its farm out agreement. I don't see that dramatically changing.
Okay, That's a good answer. The question relating to reserve-based lending, and this could be Ollie or Dougal, I think. Just questioning whether, in fact, this is really an option when we're talking marginal fields, when they're most likely to be green. I'm not quite sure what they really mean by green. New fields, when perhaps the reserves aren't fully fledged out.
Thanks.
Maybe yeah.
I think it's right that RBLs are sort of typically used where fields are reasonably close to production, or put another way, there's going to be better pricing the closer to production you are, or certainly across a spread of fields. It sounds from Dave's comments that RBLs may have been used on previous marginal fields. I don't know whether that may come either perhaps later on through the development rather than sort of the initial bid round. Obviously, it depends slightly on the particular circumstances of that marginal field, or I imagine it may be a case that where consortium members have other assets, that the marginal field forms one of the fields within the RBL borrowing base facility, borrowing base amount.
Okay, good.
Yeah, I could weigh in on that with a bit of context towards my question. The question asks because it's green. Yes, it is, but no, it isn't. Remember, it's a discovered asset. They've already done a CPR on it. That's the basis of the bid you're going to be putting in. The party that is successful wins, comes in and does another CPR, right? With the CPR and a field development plan that is acceptable to the financier, you could do a reserves-based lending, and I've seen that. But then, just like Ollie has said as well, that could be a more medium-term option of when you've attained initial production, you've got your run rate and you've run your analysis, then you could go to your financiers and say, we've got the assets, we're now at production stage, and we want an RBL based on this CPR, issued by NSIA or whoever. So, yeah.
Okay, very good. Dale, you're obviously the very popular person at the moment. Another question I think is really for you. One of the listeners has asked, it seems not very attractive to have any fiscal incentive for marginal fields. Are there any indirect benefits proposed? Would you have read anything about that?
No. So I'd seen that question and I'd referred to it in an earlier one. I would say this, right? There are proposed specific fiscal terms, incentives, which is the lower tax rates and the tax allowance that I mentioned earlier on, right? The PIB, the marginal field producers are also pushing to be able to come back with fiscal incentives as well. But the truth of the matter is, even without those fiscal incentives, these marginal fields were deemed attractive. I mean, everyone would always want a more favorable fiscal governing regime. That being said, the attractiveness would need to be independently determined. The PIB may offer certain other incentives, but as of now, we have nothing official.
Right, okay. But watch this space, I guess. It's a changing environment. A question asks, the signature bonuses to be paid in dollars when, we're aimed at local companies here who may not have dollar accounts, or certainly not substantial dollar accounts. Any reason why the Nigerian currency is not being used?
Well, historically they haven't used Naira. Historically, the industry is still governed by dollars, right? So even payments here, even though in Nigeria now we do a 60-40 split, with 60% in dollars and 40% in Naira, it's still the currency of the industry. And I think the Nigerian government is just going along with that. But also, realistically, it's also part of a hedge as well. When the government made their budgetary projections for 2020, they did make a projection for assignment fees and a bid round as part of our budget income, and they're expected about $500 million from that. I think it would also maybe be a bit too complicated to turn it into Naira then turn it back. I certainly have to, when you do have Nigerian elements, when I'm giving advice to my international clients, have to convert it to dollars just so they can get a scale of it. And you would have seen that in my presentation as well.
Yeah. Indeed.
I don't think it's a big deterrent for the if you're going into upstream for it to be in dollars, so to speak. in my opinion.
Okay. And with plans of mice and men to stick to schedules and timelines, the reality is that things tend to slip. Do you see much of an appetite, or do you see much appetite for the government to prepare to extend the timescales that they feel is what's required, or are they going to be rigid and stick to what they've published?
Well, they've already shown some flexibility. When the guidelines came out on June 1st, they said you had 2 weeks to register. Everybody was running helter-skelter, including myself. And then they extended it by a week based on pressure from those, right? So that's number one. And then number two is the fact that in the first 10 days, I unofficially confirmed that 65 people had already pre-registered, 65 companies or consortiums have already pre-registered, right? That was in the first 10 days. Now, that doesn't mean they'll pre-qual or whatever, but the interest has been there and has been there for a while. So they will, but I think those who are prepared to go into it have been waiting for a while, and, it's just like the gun has gone off and they're going to run.
Indeed. Okay. We're over the hour. There's a couple more questions. I'm happy to ask them, but maybe at that point we'll have to let people go and get on with other matters for today. But one person's asked about reserves being used loosely. Who determines it and how is it validated, since the field is marginal and may not have gone through a standardized approach for reserve estimation? I guess there's a CPR, but maybe you got some more thoughts on that, Deo?
Well, yes, to the gentleman that asked the question. So as you know, the OML holder, when they discovered the field, they would have done some preliminary work. Based on either technical or commercial issues, they decided not to proceed with the development of that, and they capped that well, so to speak, or that field, and they left it for 10 years. The DPR had that information, and they worked with that. Then after that, prior to this marginal field round, they engaged one of the companies, one of the three popular companies. I would have said the name if they were my clients. One of the three popular companies that provide competent persons reports that I, knowing them, would be generally acceptable. So that reserve in the term we're using for your commercial bid would have been done by the CPR by a known one of the three large competent person reports companies. But then, obviously, as in the development of your assets, and I used to do this when I was in-house, you have a competent person's report, and then you're doing it based on your subsurface work and your developmental work. You do CPRs pretty regularly to update your reserve report, which also gives you the ability to have more wiggle room with your financing. So it'll be constantly evolving, but part of this bid process is you get a CPR issued by an international company that has done reserves on that asset. I hope that answers that question.
Yeah, it's a very full answer. It's what I expected. Another interesting question, which often had me scratch my own head, is whether it's better to bid as a consortium or as a single company. Have you got any feedback from the government what they prefer to see, consortiums or single companies?
They actually said specifically that there is, I don't want to use the wrong word. I wouldn't say preference. They encourage, that's the word. They encourage consortiums putting in. But that's for one reason that I'll specify. They don't want a single company that doesn't have the money, to be blunt. They don't have the money or the technical to be able to, you go bid, you tie up that asset, 17 years later, you haven't produced, right? So go get a consortium together that has a more likely chance of bringing this to first oil. That being said, I'm aware that a number of companies are going in solo. A number of companies who are already upstream producers in Nigeria are setting up SPVs, right, that they wholly own, and they're going in it. And their point is, we're already producing in Nigeria. We've already got a marginal field, or we're larger than a marginal field. We don't need anyone else. So if you had that kind of backing, that you're an upstream company already in Nigeria with a record, then I don't think that you need a consortium. But if you're an SPV and it's just individuals with the expertise putting together, then you would have an advantage in pairing up with people.
Okay. Final question. It's just come in, so please no more questions after this as part of this debate, because we got to close it out. But again, Deo, clearly people are very interested about your knowledge on the process within Nigeria itself. I'm going to read it out. It's only just literally landed on the screen. You noted that the marginal field operator title lies in the farm out agreement. Okay, that's clearly understood. In relation to the recently evoked OMLs, can the government grant marginal awards in that regard, seen as there would not be an existing OML under which a farm out can be executed?
Yeah, I will answer that. If you will bear with me, I will combine it, right, Stuart, since there's a gentleman that had asked a question maybe about 20 minutes ago about the successful outcome for the DPR, how many licenses would need to be awarded. In my opinion, the last time they did about 30. In 2013, when they were going ahead, they did about 30. So for me, they want all of the 40 plus going, and that's to Martin Murphy. But in my opinion, if they get 30, 35, that should be successful. To this question now, yes, the fields, there's a bit of a misconception, right? If you're talking about the revoked marginal fields, the marginal fields are separate. The OMLs that have been revoked, I am not aware of an OML that has been recently revoked that contains a marginal field. When we talked about revoked, that is the OML. That's the head license, right? The marginal field is under that. So it's not the same. But I see the second part of your question. Even if it was revoked, right, remember that it goes back into the government's pot. So you would still be able to, I do not think that affects the title, because the government that is still granting it out still holds the oil mining lease until it assigns it to a third party, right? The NNPC, the state oil company, through its producing company, MPDC, will still hold interest in these assets. When you actually farm in or win a bid into an OML, you actually joined in an unincorporated joint venture with the NNPC. So it doesn't disappear, so to speak. So I don't think that would materially affect the marginal field rounds, should it be revoked.
Okay, that's good to hear. I think we should wrap up the discussion now. It's gone on for an hour and a quarter, which is beyond the time we said it would. Thank everybody listening. We've had 100 people on this line. It's quite a large discussion point. Thank you very much for the questions. Thank you very much for the speakers for presenting on this subject. It's obviously a hot topic at the moment. And for the very full responses and answers they gave to those questions when I'm sure they didn't have too much time to really consider what their responses are going to be. So that's great. Thank you very much. I think at this point, whether I can leave it to my IT people to actually officially wrap up the blue jeans, and I won't touch any of the buttons because I think it'll probably break if I do. But thank you, Deo. Thank you, Ollie.
Thank you, everyone.
Dougal. That's really good. The slides will be available